Hello everyone. Today we'll talk about the American stock market, specifically the S&P 500 index. If you're subscribed to my channel, you'll recall that in every US stock market review, I've recommended holding off on any buying as the downside risks on the chart were quite clearly indicated. And if you think the Persian Gulf War, started by the US against Iran, is to blame for this decline, then you are certainly correct. But that's not the main reason. The main reason is that the market itself is overheated. Later, of course, it will be very convenient to blame everything on Iran. But the reason isn't Iran, it's the US economy itself, which was overheated in terms of stock prices on the US market. I also want to point out that the global economy is like a massive locomotive or a heavy ship. It can't instantly change its speed or direction. And even the current events in the Persian Gulf, rising energy costs, oil, gas, and fertilizer shortages, all of this will impact our lives in a few months. Therefore, the stock market crash, not just in the United States but globally, could be much longer and deeper than what we are currently experiencing at this moment. Now, looking at the chart, I'll zoom in later, we see that for the last 3 weeks, the US stock market, specifically the S&P 500, closed with red candles, a decline. But this drop is quite negligible, only about 5.2% from the peak. Each yellow rectangle on the chart represents a divergence, and in each case the correction was 20%, 33%, another 20%, 35%, or 27%. Right now it's only 5%. Given the unprecedented global situation, I believe this decline should be much deeper, 30%, 50%, or even 80%. But that's all just speculation. Our job is to analyze the chart. Now let's take a closer look at it. What do we see here? This is all the marking from previous reviews. We see that the drop from the peak was 5.2%. I'm removing this. These are the estimated expectations for a possible drop to around 4,500 points. I'll remove these two so it doesn't get in our way. And finally, we see that at the moment we had a sort of flat sideways zone, and the support for this zone was the 6,800 point level. Already last week the index broke through this support level, and this week it closed even lower. This suggests that the decline is likely only gaining momentum. And note that both last week, which closed with a drop, and the current one opened with a gap down, a break. And such gaps are often called runaway gaps. When the trend is just at its beginning, it's gaining strength. How far could we fall? The first technical target, quite obvious, is the 50-week moving average, the level of 6,400 to 6,420 points. Well, the next one, accordingly, is the 100-week average, around the 6,000 point mark. If we try to look at the candlestick structure to see where the market might go, the nearest support is at the base of this red candle, or rather at its closing point, but we haven't reached it yet. With a very high probability we'll reach it next week, maybe opening with another gap down, but this is nothing more than an intermediate level within the current situation. Again, a decline and divergence playout of only 5% is very little. The next technical level that suggests itself, well, objectively suggests itself, is right here. I would even say right here, the green candle where the correction started, where there was a long pause, and after breaking its close, we went much higher. This is the 6,070 point level where the 100-week average is heading. I would mark this level as the immediate base target, but it's unlikely to be the final one. That's how everything looks at the moment. I strongly advise against buying the United States stock market right now. Of course, a situation could arise where Trump announces victory, the end of the military operation, and for a while, the stock market might go up. But that doesn't change the fact that it's overheated, and much points to a decline to the indicated area of 6,000 points at least. On the monthly candles, I've removed all markings, leaving only the moving averages. Green is the 50-month, red is the 100-month, orange is the 200-month, and finally blue is the 300-month. We can see that in February there was no bearish engulfing of the January growth candle, which, by the way, set an all-time high for the index. And this means there were no formal reasons to open short positions. But this month, quite likely 2 weeks before the month ends, we could see a bullish engulfing of several months of growth at once, including even last October. And if this happens, then we have every right to expect a decline at the very least to the base of the September candle. That's around 6,360 points, and potentially even to the 50-month average. For what reason? Well, because of divergence, because of a bearish engulfing pattern, and because of the horror unfolding in the world, specifically in the Persian Gulf, which will spread across the entire globe in the coming months. And let's note that the index already dropped to the 50-month average in October 2022, and even to the 100-month average in March 2020. This means it's not at all out of the question to drop not just to the 100-month average around 4,200 points, but also to the 200-month average near 3,000, and even the 300-month at 2,400. Of course, they are trending upwards dynamically, and these values might change, but I've laid out the key targets for you. We are essentially at the very beginning of a downward phase, and it could turn out to be quite a deep one, so please be careful. On the daily candles, the index broke through the 50 and 100-day moving averages, came very close to the 200-day, and the key support, essentially the buyer's last line of defense, is the 6,500-point level. That is the candle from November 20th of last year. So if we break through this level, we can say that the market has entered a full-blown bearish phase. Until then, we can't rule out some bounces or even a return to new highs, but that is absolutely no reason to buy this index. I want to remind you that I'm doing this review on the QuantFury platform, where you pay absolutely zero commissions and can trade not just stocks, but also cryptocurrencies, indices, commodities, oil, gas, and many other financial instruments. My choice is QuantFury. If you'd like, use the QR code to go to the platform. Now let's look at another tool. These are charts featuring my own custom indicators. These are the weekly candles for the E-mini futures on the Chicago Mercantile Exchange. Still the same S&P 500 index. What do we see here? The yellow and pink rectangles represent what I call mathematical downside targets. I came up with the name myself, but this is my indicator. This orange target was formed back in December of last year, and as you can see, the index has reached it. But we also have a pink target. It was formed much earlier in November of last year, and we could drop down there as well. That's around the 6,200 point mark. Notice how in this area the index just kept rising, and targets were being formed that were never actually hit. Right here, orange, pink, and orange, then pink and orange again, and then in one fell swoop, all targets were hit with a large margin. Consequently, it's perfectly possible to go further down to both the 100-week and the 200-week levels. There's also an indicator, the bottom one, the red line, which shows the overbought or oversold status of a specific financial instrument. Notice that when the index was moving up in this area, this indicator was essentially flat, meaning it didn't show any growth. Yes, it showed us maximum overheating, but according to this indicator, a downward move potentially starts when it was going up and then turned down, making a break or a reversal. So our first full-fledged break happened in this area, right? And let's see what happened next. Well, there was only one downward candle here, but then the index goes to new all-time highs, while the indicator is at much lower highs. And this is a full-fledged divergence with this indicator. And this indicates that very serious prerequisites for a decline have formed here. And as long as this indicator is pointing down and we haven't seen a reversal, a change in direction from bearish to bullish, we can expect the downtrend to continue. And even when we reach this green oversold area, no one said the market has to reverse. In other words, we can stay in this area as long as we stayed right here. Let me draw it again. There are a million drawings here in the overbought area. Look, we entered the overbought area and stayed there for a very long time, and the same thing can happen in the oversold area. Therefore, refrain from making any purchases. Now I'll remove all the markings I've made and show you the monthly candles. On the monthly candles with my indicators, we have the following situation. There's a downside target around 6,000 points, and also, well, there is a target, but it was already hit. It appeared on this red candle in March 2025, and by April, both targets, orange and pink, were hit, so we can't refer to it. But nevertheless, the target on the monthly candles to drop to around 6,150 points, 5,930 points, is quite clearly drawn. And here, if we remove the arrow, we also see a break in the indicator, showing that on the monthly candles we have quite strong overbought conditions, and there's still plenty of time and many monthly candles before we reach the oversold area. Therefore, we might not be limited to a decline to the 6,000 point area. If you find this content useful, then subscribe to the channel. And the next review will be on Bitcoin and Ethereum. We'll analyze the situation in the cryptocurrency market. Goodbye.